Well, in the essence of time, go ahead and get started. We certainly appreciate everyone joining today. I am Frank Rhodes II with Marriott International, Area Director of Engineering and Facilities, but currently IFMA Boston Chapter President. And on behalf of the Chapter President and our committee chairs and volunteers who are orchestrating today's program, I'd like to say thank you for joining us. It is so nice to see everybody that could be here today. And for those that could not, please make sure that you reach out to them if you are friends. We want to make sure that this content does get to all of our members and the ones that would like to join and get the most out of what we can do. So IFMA Boston is the only organization in the area that is dedicated to the facilities managers. IFMA Boston supports facility management professionals so that they can excel in their careers by providing relevant education content, industry knowledge, sharing peer-to-peer networking. Each of our leadership team members has an IFMA Boston virtual background that you see on my background today so that you can identify us. So when you're in those breakouts, certainly feel free to ask us any questions, direct message us afterwards, or even connect with us on LinkedIn. For each of our non-members in attendance, we wanted to make sure that you do join our chapter as well and you see this as relevant content. So if anyone of you do join in the next week, we're going to offer you a $25 Visa gift card. So not only will you be joining the third largest organization, but the strongest chapter. And in most recent years, in 2019 and 2018, we were recognized at World Workplace. This afternoon, we are lucky to be joined here by Dorian Klein from Harvard Extension School, here to impart the wisdom with us. But before we do that, we want to have a few minutes to network. Chris will be helping put us in breakouts, roughly 4, might be a little bit more based on the number of attendees that we have. We ask that you introduce yourself quickly because we do want to make sure that we have time for the content. But we're going to look forward to what economic concerns keep you up at night. Labor, inflation rates, supply chain, recession fears, or something else. So we're going to ask that somebody takes notes within each breakout, and we're going to give ourselves 8 minutes for that breakout. And I'm going to ask Chris to go ahead and place us in that breakout. All right, welcome back. I hope that all of you had a chance and a moment to meet somebody that you haven't met before. I certainly did with Jill being in my breakout. But we want to make sure that you know that we are committed to helping you and your connections and leveraging for your position within your own industry. So we're going to turn it over to today's speaker and moderator. I am pleased to turn it over to John Boucher, Director of Facilities, Planning and Management at the Harvard Arts Museum, recently appointed, and a member of our think tank and co-chair of Career Expansion Committee. He will kick us off this afternoon. Over to you, John.
Thanks, Frank. Hello, everybody. You said John Boucher, Harvard Art Museums. I think we were hoping if you could throw in the chat any of the topics you thought were really important, that would be great. So just for folks who don't know me, I actually been at Harvard for 20 plus years. I used the Harvard Extension School. I took classes there. I graduated from there a couple of times. It's a great resource. So anybody interested in furthering their education in a very flexible way, I encourage you maybe to check out the Harvard Extension School. And so in that same light, we have Dorian Klein here, who's an instructor in economics at the Harvard Extension School. Dorian, you were telling me, I think you've taught 35 different courses, or might have even been more.
I think more like 65, 70.
Yeah. So yeah, been around a long time, about 8 years. So I'm sure you have some insights into what's going on economically right now. Looking through the chat, I see supply chain issues, the issues with sustainability, kind of, I think, Frank, you might be referring to how being forced upon you without the economic backing, how you're going to pay for these sustainability goals. Let's see, lack of control on budgets, deferred maintenance, recession, second half of 2023. So a lot of things out there that are worrying folks. So I'd like to turn it over to Dorian and let him impart some of his knowledge.
Well, thank you, John, and thank you for that introduction. I'm very happy to be here with you guys today, and I know you perform some absolutely vital functions. I know I enjoy, John's domain, the art museums and all that at Harvard very much, and I think it's a great thing to be able to talk to you today and impart some of my views. And I want to start by saying that remember, economics is not a physical science, it's a social science, so there's no right or wrong. And that's why you see so many dissenting opinions among economists and policymakers always, and that will remain the case. I know we don't have a lot of time, so I have a few slides. The rule of thumb in presentations is 2 to 3 minutes per slide. I have 25, so I'm gonna break that rule, and I'm gonna try to make them about 1 minute per slide. And I'm gonna try to share my screen, and just so feel free to interrupt me rudely if you need to at any time. I do like to talk and go on, so feel free to stop that and or save your questions for later. So let me just share my screen. I think I need to have screen sharing enabled by the host. I'm not sure who the host is, but
Janessa, or
Janessa may not be on. And I do.
Who's been managing the breakouts? Can that person? I think that person might be. Do you think they might have access?
Yes, I'm trying.
okay.
Okay, thank you.
You should be able to do it now.
okay. Yep.
Okay.
Here we go.
Thanks.
Okay. Do you see the first slide up here?
Yes, good to go.
Okay, great.
Thank you.
Okay, so what I'm going to try to do is give you a sort of helicopter view of the economy and how we ended up where we are today. A few views on some of the main issues. I think they sort of match pretty well what I quickly saw on the chat before I started talking, and then also look to see if we can have some views on where this is going in the next year or two. It's very difficult to predict it for much longer, but there are some market criteria that we can use to predict, for example, the level of interest rates and things like that. So I'm going to concentrate on inflation, because I do think that inflation is the main culprit of a lot of the issues we're having today. Obviously, there's many other causes, the pandemic crisis and the lockdowns and the Chinese supply chain disruptions and everything else are also effects, but also causes of what we see as inflation, which is as you can see, it's a funny situation, because not so long ago, for the last 10-15 years, we've been talking about inflation as being dead, and most people worried about deflation, and especially in Europe and Japan. Well, Japan's been worrying about deflation for about 30 years, but in Europe for the last 10-15 years, that was the main concern. And in some ways, deflation is actually worse than inflation. So just so you So you can compare the two. And you see here, same publication, 2019, is inflation dead? And is that a worry? And look at that, a new era has some frightening downsides because inflation is dead. And then from, about a year and a half ago, inflation is back, and but maybe it's not so bad as we might have thought. So so focusing on that, it affects pretty much everything. And this is really a telling story. I know, it's not so, you're not so much worried about your 401k returns, or maybe you are, but this is a story of where the markets were in 2022, and this shows you, historically going back to 1976, the different returns for either bonds or stocks, right? So that's the normal portfolio mix that most people have is, bonds or stocks or cash. And, we're not talking about hedge funds with derivatives and other things. And you see almost every year, except for 1994, you have a positive return in one of the two, right? So either you have on the Y axis, you have, bond returns, and on the X axis, you have positive stock returns. The only year on here, except for 1994, and that's negative for both, is last year. So, this is an unusual circumstance in the markets. You always talk about portfolio allocations in investments as being either stocks or bonds. And, usually when one goes down, the other one goes up, or at least it saves you from having a loss. Last year was one of the very few years where you actually had a negative return in both. As you can see, for stocks, about 20% down, and for bonds, because of the rising interest rates, which we're going to get into, you had about a 12 to 15% negative return. So, the question arises, why do we have inflation again? It's supposed to be dead. For many years, actually the Fed was trying to, not to mention the Bank of Japan and the European central banks, were trying to find all sorts of ways to actually create a little bit of inflation. If you follow the Fed's actions over the last 15 years since the financial crisis in 2008 and 9, they always kept saying, our target is 2%, but it doesn't mean that we want inflation under 2%. We want inflation to go around our target. So some years would be 2.5, some years would be 1.5, and they're actually having trouble creating, creating a little bit of extra inflation, which often is also associated with growth. So again, remember that time, for many years, up until last year, not so much in the US, but in Europe and Japan, we had 30% of the global bonds actually had negative yields. Think about that, right? Negative yield means that, you're actually willing to lend to someone and actually pay for the, I guess, right to lend to someone. So, in economic theory, by the way, that doesn't exist. You cannot have that. The idea of having a negative incentive, to lend is not covered by economic theory. So, we have some very weird and interesting situations up to last year, when we had another weird situation that all of a sudden we have, high inflation all over the world, despite the expectations up to then. So what happened? How did that come about? So I'll go through a few slides in the next few minutes, and we'll look at some of the issues that are associated with that. Obviously monetary policy is key. fiscal policy is key. The ways that consumptions and savings operate was actually a very important factor over the last few years, particularly since and after the pandemic crisis. And then we'll also look, I know you're particularly concerned in supply chain disruptions. There's maybe some good news there, which I'll try to go through. And I think the labor market has changed for, I was listening to you guys while the breakout sessions were going on and talking about how the new office of the future is gonna look like, and what happens to work from home and things like that. I think that's pretty much a permanent change, and I think that will affect your work in particular, but everyone else. I have twins who just graduated from college last year in 2022. They both started new jobs, one in London and one in New York, and they're very upset because they want to go into the office. They want to have that camaraderie and that networking possibility in the office, and both of them are basically in companies that say office presence is pretty much optional. I think requirement is 1 day a week. It's not even a requirement, the recommendation. And I think that's as an old timer, when I started on Wall Street many years ago, I enjoyed going to the office. That was the place where you hung out. So I think there are many changes in the workforce, and which will affect, to a large extent, what you guys do, because that's gonna, I think, again, it's not a physical science, but my prediction is that that's gonna stay on for a long time. And then we'll try to look at how the market is predicting the future for some of these events. So again, feel free, if you have a question, just talk. Don't raise your hand or chat, because I'm not probably going to see that. So what is the story on inflation? Well, this is a long view on inflation. You've probably seen these charts before. This is going back to 1965. There was very little inflation really until this period in the early 70s, which is a long story. We don't have time for it today, but remember that most of the world economy was on the gold standard until 1971 or so. So one of the advantages, there are disadvantages as well, but one of the advantages of a gold standard, which was the case for about 200 years, is that it reduces inflationary impacts, because a lot of the shocks are actually taken up by the change in gold reserves. So that's why you see, going back, if we go before 1965 all the way to 1800, inflation was not really a main issue. It started here in the 60s as the Vietnam War and the decline of gold reserves in the U.S. Created some inflationary pressures, and then it really took off in the 70s and early 80s, as you probably know, because of the two oil shocks in 73 and 79, and also because the world was not accustomed to a free exchange rate system without a gold backing, as was created after 1973. Just as an anecdote, I actually started my finance career in 1980. As you can see, was not the best time to start from a financial point of view, but Paul Volcker at the time, introduced the idea of using interest rates, and up to then, just in terms of monetary policy, again, because of the gold standard and other features, it was monetary policy consisted mostly of changing the money supply. and it took until Paul Volcker in the early 1980s to realize that that was not enough to influence inflation. So he introduced the concept of interest rate management as being the main inflation fighting factor. And that worked very well. As you can see, for several decades, we had very reasonable inflation around that 2 to 3% range, which is what most central banks advocate as the correct range to be, around 2%. That's the target for the Fed. That's the target for the European Central Bank. Japan wishes it could get there, but they're always a bit below. And frankly, it's the range that we had. And then that got a little bit out of whack, the last couple of years, and as I'm sure you've read in the news. So just to go through some of the causes, as I described before, I'll just remind you, monetary policy, fiscal policy, consumption, and all that. By the way, I'll make the slides available, of course, so you can look in more detail later. This is the effective federal funds rate and futures as by the way, there's a misconception where people think that the Federal Reserve sets rates. They don't set rate, they give guidance on rates, and everyone sort of follows because there's such a powerful and frankly bullying type of institution. So that's equivalent to setting them. But you see, there were a zero after the financial crisis for 7 or 8 years. Then the Fed said, well, zero is not a good place to be. So they tried to bring them back up for a few years. And of course, when the pandemic came, everything went back to zero again. So the looseness of monetary policy is one of the factors that, of course, contributes to potential inflation. So, now, was that an overreaction in 2020, going from 2% or so to zero immediately? Or is this an overreaction in 2021 and 2022, going from 0 to 4.25%? Unclear. This is the prediction. We'll go through this some more. The yellow line is the prediction of where, not a prediction by guessing. It's a prediction by the implied rates of the futures of interest rates. So it's a market prediction based on a lot of different factors. So, usually pretty accurate. So you see that the prediction is that it's going to keep going up a little bit, but then it's going to start going back down. So, more on monetary policy. There's two things that the Fed has been using since the financial crisis: interest rate policy and also quantitative easing. That's the QE up there in the title. Quantitative easing is basically buying securities. And look at the balance sheet. That blue line, the shaded gray area, is the size of the balance sheet of the Fed. Maybe you've seen this before. For many, many years, going back, into the 1990s, the Fed was a pretty boring balance sheet. Basically had, invested in treasuries on the asset side, and it had currency on the other. So currency outstanding. So it was around that 700 to 800 billion level that you see here in 2008. After the financial crisis, the Fed took very aggressive actions. By the way, personally, I completely agree with their actions around that time. I think that's what they needed to do to calm the markets, to provide liquidity. So even though they were very aggressive and unprecedented, you see that Fed balance sheet going up from 800 billion or so to basically, about 4 trillion by 2020. Now, what's I'm sorry, to 4.5 trillion by around 2014, 5-6 years after the financial crisis. Now, they tried, as I showed you on also the interest rate slide, they tried to bring that back in because, the idea is not for the Fed to be such an important part of the markets. The Fed are supposed to regulate the markets, but not necessarily influence them. And then it doubled again to 9 trillion in 2 years, because of the pandemic. And now, was that excessive? Probably, and I think that's why you see that they're really trying hard to bring it back down, but that's very difficult. Once you stimulate the markets, once you provide all that excess demand to the markets, it's very difficult to take it back because the markets will react very negatively. And just to see how someone asking a question? No? Okay, so just to see how powerful an impact these Fed moves have on the yield curve. This is the most important thing you look at in terms of bonds and the economy. And you see here the red line is the Treasury yield curve. In other words, the interest rate on treasuries of different maturities, which are here on the bottom, on December 31st, 2021. Look at that nice, you'd like to see that low and rising yield curve. That's what looks good to economists. And you see that only a year ago. This is only a year and a month ago, and then everything changed in 2022. And look how much higher the interest rates are for every maturity. But more importantly, you look at the shape of the yield curve, and a rising yield curve is the natural way it should look. Why is that? Because you have a premium for longer maturities. It's more uncertain. It's longer term that you have to hold the bond for, and all of a sudden we get into this pretty much inverted yield curve. That's what we call it. And you see that, for example, 3-month, or 6-month treasuries, have a yield of 4.73. So that's what the market expects from that. And 10-year treasuries are actually lower. Whereas in, a year ago, 6-month treasuries, 3-month treasuries was 0, and 10-year was 151. That's what you would want. So what does that mean? An inverted yield curve almost always predicts a recession. So you see here for the last 30 years or so, every time you had, this is this chart shows you the difference between the 10-year treasury minus the 3-month treasury. So just to refer it back, you take, for example, right here around 2019, you see there's that difference would be, well, we don't even have 2019, but let's look at 2021. 2021, you'd have somewhere around here, you see about 1.5%. So if you look at the previous chart, 2021, the difference between the 10-year 151 and 3-month is about 1.5%. So, but every time you see that difference go negative, it's immediately followed by a recession. So you see it in this chart, and here is a longer term chart, and it's the same thing. Every time you have this negative, it predicts a recession. So I don't want to be the voice of doom, but but that's the case. So so that was monetary policy. Let's look at fiscal policy. That's the other way government tries to stimulate the economy so that it doesn't go into a recession. It avoids it avoids it. And this is the last few major recessions that were addressed by fiscal policy. And you see, and this is, this is not actual numbers. This is actually percent of potential GDP. So they are completely comparable, so you don't have to say, well, 6 trillion today, which I think is the latest estimate of fiscal stimulus is, is a lot today, but it didn't mean as much in 1969. This is as a percent of GDP. And even as a percent of GDP, you see the current fiscal stimulus is at a record high. I'm not even sure if this is, no, this is in 2020. So we still have a few stimulus bills that are not counted there. Now, what is the difference between the two colors? It's fairly significant because the dark blue shows you what happens to the deficit just because you're in a down cycle in the economy. So if the economy is growing less or declining in a recession, then you are going to have an automatic type of deficit in the budget. This is by the way, deficit in the fiscal budget of the government, the federal government, and so it's okay to see this sort of deficit, because this is in principle correctable also automatically by the economy getting back into a different cycle. But you see for this cycle, most of it is actually government induced. So that's great. Why is that important for inflation? It's creating extra demand, and not necessarily efficient or effective demand. It may be necessary to make sure that the economy doesn't collapse, but it will have an effect on inflation. So something that we don't often think of.
Did we lose connection?
Oh, did I lose you?
Yeah, you're not sharing anymore.
Oh, okay.
Thank you. Thanks, Dorian.
We can hear you loud and clear, but just not sharing.
Okay, can you see the slides and hear me?
Yes.
Yes. And Dorian, not to rush you along, I think we have a 12 end
Okay.
time. So
Sorry.
I think we have a 1 o'clock end time. So just be aware.
Okay, so let me move a little faster. So let me just show you a few more slides, which is a key part of inflation and growth. This is the housing affordability index. It's at a low historically, going back to 1990. So people can't afford houses, therefore you're not going to have a lot of growth in that market, although consumption, which is a big piece of it, and that's income minus tax minus savings. And you see two things here. This is the savings rate for the US, and a lot of the programs and plans that were put in place, the stimulus bills and all that, the extra payments, created huge rise in income. That's what's affecting the labor market to some extent, because people didn't really use that money for consumption. They actually saved it, so now they can afford to stay out of the labor market for a while. So let me just go into quickly into some forecast. This is a market forecast of the Fed funds rate. So that's going to affect a lot of things, investment, mortgage rates, the economy growth, corporate profits, a lot. And that's the good news, is that it's going to be lower in a year or so than it is today. So, looking at another indication, this is the leading economic indicator, which is closely followed by many economists. And this shows you the average recession and the median recession, and this dark line shows you what we are today. So we're definitely in that run up to a recession, as you can see here, and we're presumably going to follow some sort of scenario like the one on the right, which means that it'll take about a year or two to get back to the level we are today. So some good and bad news. And in other parts of the market, this is import prices and export prices going back to 92. You see the changes here, and what everyone was talking about. And this is basically an indication of a trade disruption, trade supply chain. And you see that although it went very high in 21, 22, in 22, it actually started declining and getting back to fairly normal levels. Same with some other, we could show this for many other industries. Used car prices, I'm sure you all know, is a good indicator of other types of fixed assets. And, it went, a record high in 2021 because of the disruptions to the supply chain, the fact that, many factories were not working at full hill. But you see the economy, the U.S. economy is fairly resilient, and we're now back to normal. So a big cause of the financial crisis 15 years ago or so was housing. You see that housing prices going up from this level to this level in 2006-07, and unfortunately we have a very similar type of situation today after a major rise. So other things to look at, I'm going to go through this very quickly. Dollar strength, commodity prices, tight credit, labor participation and work from home, China supply chain and COVID lockdowns, and the Ukraine war. Just to show you a couple of slides again, sort of correcting, although some bad news. You see here the default rate, which is the yellow line, is actually pretty good. It's gone down, but banks are really tightening their credit procedures and regulations. So let me just finish with my conclusions. So many caveats. Again, this is just some views of the market as a whole. I think recession is coming. I don't know how long it would last. Most economists think most recessions last between 6 and 18 months, and maybe we're in a recession already. Inflation is going down. It's still going to be higher than that 2.5% for a while, but maybe not as high as it's been. The rates, which affect a lot of things, the interest rates are going to stay high, but on a downtrend. My personal opinion is that work from home is here to stay, and that will have many, many implications on commercial real estate, for example, office real estate, and also residential housing. I think supply chain issues that we saw a year ago or so I think those will work out themselves. I have a whole other presentation on freight rates and things like that. That seems to indicate an improvement in that market. Labor market, I think, will remain difficult. People have left, the market for good. I know there's shortages everywhere, truck drivers, hospitality workers, all that. And I think that will remain the case unless there's some major shift in the economy. Housing prices, sales prices are declining, but rental prices are rising. And I think commodities and agricultural prices, because of many different factors, are not gonna get much better. They'll keep rising. So sorry I took a bit long. Again, I broke my rule on number of minutes per slide, but that's sort of a short view on the economy. So welcome any questions you may have.
If you stop share, maybe might be
Stop.
easier to see if you stop share. Any questions?
Okay.
Yeah, I have one. What are you thinking about the push to have more things manufactured here in the United States, and how might that impact sort of both the US but also sort of globally? What are the backside implications of that?
Yeah, I personally I'm for it. I think we've come to the point where we're way too much dependent on 92% of manufactured personal goods are actually made in China. That's too much. Something like 97% of antibiotics in the US are actually made in China or India. Even the US Air Force, 40% of their spare parts are made somewhere in Asia. I don't think that's sustainable. I think, that was economically, the idea of global trade and globalism, that you grow the global pie, right? So I think that's worked out very well. I think, it hasn't worked out for some segments of the US labor market, like manufacturing, obviously. But you can make the argument that there's some other shifts, maybe in services or things like that. But I think when it comes to actual, need supplies like drugs or, military spare parts, I think chips, which is a big one now. I'm sure you all remember when there was a shortage of masks and gloves, right? When the pandemic started, because they're all made in Asia. So I think that there needs to be some shift back to some local production and supply. Now, what's the downside of that? Is the prices will be a bit higher. So it's unclear whether that's because just prices are lower outside, or there was maybe some price manipulation. But at some point, for some of these critical industries, I think that needs to happen. It's my view.
Leanne?
Yes, I have a question. What are your thoughts about how the Northeast will fare with the recession, at the end of, coming in 2023/2024?
Whose view? Sorry, I didn't hear.
Are the Northeast, our area? How do you think the whole Northeast area will fare?
Yeah, there are some shifts in the economy. If you look at the migration patterns, New York and California have the most negative net migration within the U.S., and Texas and Florida have the highest positive migration. So I don't know if that's because of restrictive lockdowns or something, or it's because the economic aspect is better there. Probably a combination of the two. You know, I know that Miami, believe it or not, you know, has spawned more new companies than Silicon Valley in the last 3 years. So you know, that's partially tax, partially regulations, other things. I think Northeast is you know, is always going to be a big center of, you know, academia for one, some manufacturing, innovation. I mean, you know, Moderna is based in Cambridge, things like that. But it's becoming, I think the U.S. is becoming a lot more competitive, and I think, you know, in terms of population migration and company migration, I think, unfortunately, I hate to say it, but the South is gaining. You know, so you know, even as a Northeasterner myself and a Harvard guy, but you know, it's that's the trend, I think.
Thank you. So certainly we're up on our time. Appreciate everybody for joining us today. I did want to take a moment to highlight our backgrounds and thank all of our sponsors that are on our virtual backgrounds as IFA Boston chapter leaders. We hope that everyone had and found value today, and certainly reach out to anyone that you have not met or that you saw that was an attendee, either via LinkedIn or via chat. We will certainly be available and look forward to further conversations. But certainly each of our programs, whether they are virtual or in person, include networking. So we have an upcoming program, and this is a pop-up on January 25th in Medford at 5:30. And in February, we're going to have another pop-up thought leaders program that will be held virtually. And this is on March 22nd, if I remember. And then on March 22nd, we have a live in-person program, which is managing narcissists, naysayers, and know-it-alls. So I think we probably have all met one along our path. So that'll be a very interesting and great fun-filled conversation. And then lastly, I do want to make sure that we have a call for submissions for our 20th annual Awards of Excellence and FM Forward Conference that's going to be held on May 10th at Bentley University. And I will close and say thank you again for attending. We hope you have a great afternoon and enjoy the rest of your day. Take care.